Welcome back to AlgoBot, the channel where we break down automated trading strategies for MetaTrader 5, one expert advisor at a time. I'm your host from AlgoBot, and today we're exploring a continuation strategy called FVG Momentum Pullback. Over the next several minutes, you'll learn how it combines a price structure idea, the fair value gap, with a momentum filter built on the Relative Strength Index, or RSI. We'll walk through its logic, read the actual MetaTrader code, and trace 2 example trades on a chart. This is educational content only, so let's dive in and see how the approach is designed to think. So what exactly does this expert advisor do? At its core, FVG Momentum Pullback is a continuation system. That means it doesn't try to predict tops and bottoms or fade strong moves. Instead, it waits for the market to show its hand with a decisive, one-sided move, and then it looks to join that move on a pullback. The strategy is built on 2 independent ideas that must agree before any position is opened. The first idea is structural, and it's called a fair value gap. A fair value gap is the 3-candle signature of an efficient move. When a single dominant candle travels so quickly that the candle before it and the candle after it never overlap, it leaves behind an untraded pocket of price. The strategy treats that pocket like fresh demand on the way up or fresh supply on the way down, because price often revisits it once before the original direction resumes. The second idea is momentum, and that's where the RSI comes in. On its own, buying into a gap can be a trap because a gap can form on the final push of a fading trend. The RSI acts as a gate. A bullish gap is only considered while RSI holds the upper half of its range, at or above the trend level of 50. A bearish gap is only considered while RSI holds the lower half, at or below 50. In short, the gap tells the strategy where to look, and momentum tells it whether the move still has life. This approach is naturally suited to trend-prone, liquid instruments, such as major currency pairs like euro-dollar and pound-dollar, gold, and stock indices. It's most at home on the 15-minute through 1-hour time frames, where these gaps form often enough to be useful, but are still meaningful when they appear. Every threshold in the system scales to either the average candle range or to ATR, so there's no fixed pip math, and the same logic adapts to whatever symbol and time frame you test it on. It's designed for traders who prefer a patient, rules-based, momentum continuation style. Remember, trading involves risk, and losses are a normal part of any strategy. Let's walk through exactly how the strategy operates, step by step. Everything begins on the close of each new bar, when the expert advisor re-examines the 3 most recently closed candles to see whether a fresh fair value gap has formed. For a bullish gap, 3 conditions must line up. First, there must be a true gap in price, meaning the high of the oldest of the 3 candles sits below the low of the newest candle. Second, the middle candle, the displacement candle, must be bullish and body dominant, with its body making up at least 55% of its full range by default. That confirms the move was decisive rather than indecisive chop. Third, the gap must be wide enough to matter, at least a set fraction of the recent average candle range, 25% by default. A bearish gap is the exact mirror. The low of the oldest candle sits above the high of the newest. The middle candle is bearish and body dominant, and the gap clears the same minimum width. Once a gap is detected, the strategy tracks just that single most recent imbalance and waits. It does not enter immediately. Entry only happens on the pullback, at least 1 bar after the gap forms, when price retraces back into the pocket. For a bullish gap, the EA signals a buy when the ask price re-enters the gap zone and, crucially, RSI is still at or above the trend level of 50. For a bearish gap, the EA signals a sell when the bid price re-enters the gap zone and RSI is at or below 50. Both the structure and the momentum gate must agree at the same moment. Risk is defined the instant a trade opens. For a long, the stop loss is placed a buffer below the base of the gap, and that buffer is a multiple of ATR, so it adapts with current volatility. The take profit is then set as a multiple of that stop distance, with a default reward to risk of 1.8 to 1. For a short, the stop sits a buffer above the gap, and the target mirrors it. The strategy also manages housekeeping carefully. Only 1 position per magic number is allowed at a time, so it never stacks trades. A track gap is abandoned if a candle closes straight through its far edge, which means the structure has failed, or if a set number of bars, 15 by default, pass without price ever returning to tap it. And before any entry, the strategy checks that the spread is not wider than your chosen limit. Each gap is traded at most once, then discarded. Now let's look at the actual MetaTrader 5 code that drives all of this. At the top, you can see the input parameters, the dials you can adjust before running the EA. RSI period sets the smoothing for the momentum gate, defaulting to 14. Trend level, defaulting to 50, is the regime line. A long needs RSI at or above it. A short needs RSI at or below 100 minus it. ATR period feeds the stop buffer. MinGapFrac sets the minimum gap width, and body dominance controls how one-sided the displacement candle must be. SLTR multiple scales the stop buffer. RewardRisk sets the target as a multiple of risk. Expiry bars decides how long a gap stays valid, and range window is the look back for the average candle range. Below that is the buy block. The code reads the current ask price and checks three things in a single condition: that the ask has fallen back into the gap, meaning it sits at or below the gap high and at or above the gap low, and that RSI is at or above the trend level. When all three are true, it computes the stop loss a buffer below the gap low, measures the risk as the distance from entry to that stop, sets the take profit at reward risk times that distance above entry, and calls trade.buy. The sell block is the mirror image. It reads the bid price and fires when the bid has risen into the gap and RSI is at or below 100 minus the trend level. It places the stop a buffer above the gap high, measures the risk downward, sets the take profit reward risk times that distance below entry, and calls trade.sell. After either trade, the gap is marked inactive, so each imbalance is acted on only once. Let's bring it all together on this illustration. On top you can see the price candles, and in the panel below is the RSI, with a dashed line marking the trend level at 50. Above 50 we'll call the bullish regime, below 50 the bearish regime. Watch how the strategy reads both at once. We start on the left with quiet, small-bodied candles, the market drifting without conviction, and RSI hovering right around the 50 line. Then comes the key event for our first trade. A single, strong bullish candle pushes higher with a large body, the displacement candle. It moves so quickly that the candle before it and the candle after it leave a clean, untraded pocket between them. That pocket, shaded in green, is our bullish fair value gap. Notice that as this candle prints, RSI lifts firmly into the bullish regime above 50, telling the strategy the move has genuine momentum behind it. Now the strategy does not chase. It marks the gap and waits patiently. Over the next candle, price cools off and drifts back down, retracing into that green pocket. This is the pullback the whole strategy is built around. As price re-enters the gap, the EA checks its momentum gate, and RSI is still holding above 50, still in the bullish regime. Both conditions agree, structure and momentum, and the buy entry marker fires right there inside the gap. The stop loss is tucked a small ATR buffer below the base of the gap, just under that pocket, and the take profit target is projected above at 1.8 times that risk distance. From there, watch the continuation. Buyers step back in exactly where the strategy expected fresh demand, and price pushes up candle after candle, leaving the gap behind. RSI climbs deeper into the bullish regime as the move extends. A few candles later, price reaches the take profit target, and the long trade is complete. That's the full long cycle, a decisive move, a gap, a patient pullback with momentum still intact, an entry, and a target. Now the market rolls over, and we get the mirror image. Near the top, a strong bearish candle drops with a large body, another displacement, and once again it leaves an untraded pocket above it, this time shaded red, our bearish fair value gap. As that candle prints, RSI breaks down through 50 into the bearish regime, signaling that momentum has flipped to the downside. Just as before, the strategy waits for the pullback. Price drifts back up into the red pocket, retracing into the gap. As it does, the EA checks the gate, and RSI is still pinned at or below 50, still in the bearish regime. Structure and momentum agree once more, and the sell entry marker fires inside the gap. The stop loss sits a buffer above the top of the pocket, and the take profit target is projected below at the same reward to risk multiple. Then the continuation plays out to the downside. Sellers take over right where the strategy anticipated fresh supply, and price falls candle by candle, with RSI sinking deeper into the bearish regime. Price reaches the lower take-profit target, and the short trade is complete. 2 trades, both following the same simple idea. Trade in the direction of the displacement, but only on the pullback into the gap, and only while RSI confirms the momentum regime still agrees. And that brings us to the end of our breakdown of FVG Momentum Pullback. We covered the core idea of pairing a fair value gap with an RSI momentum gate. We walked through the exact entry and exit logic. We read the MetaTrader 5 code for both the long and the short side, and we traced 2 example trades from setup to target on the chart. Remember, everything in this video is for educational purposes only. It is not financial advice, not a recommendation, and not a solicitation to trade. Every strategy carries risk, and losses are a normal part of trading. If you found this analysis helpful, please like the video, leave a comment with the strategy you'd like us to break down next, and subscribe for more MetaTrader 5 strategy analyses. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.